Hello, I'm Stephen from TEFAT, and today I'd like to give a management accounting principles presentation. It's part of the management accounting syllabus at TAFE NSW. It may have changed since I did it in the late 90s, but it probably still is in the syllabus. But I'll introduce some terms first. It's a part podcast format, which is what I've been doing. Fixed costs stay fixed over a range of production, such as a machine, but if manufacturing output increases substantially enough, then you need more fixed costs, more machines, because the machines eventually get to full capacity. So semi-variable costs are variable costs which may change over a range of production, such as casual workers at Christmas, but variable costs always change with output, such as manufacturing materials, fuel and electricity. So that's the definition of fixed costs, semi-variable and variable costs, and these occur in economics as well, microeconomics. So direct costs are directly charged to manufacturing, such as manufacturing labour, manufacturing materials, but indirect costs are costs that are not directly associated with manufacturing in other departments such as logistics and marketing. And also on the profit and loss statement, indirect costs are costs below gross profit in the revenue statement, gross profit being sales minus COGS. So then you've got to, in management accounting, you've got to allocate your costs and get it to an hourly rate. And the traditional cost allocation for production, oh, by the way, my source for this, it's written on the whiteboard, is Management Accounting Principles Learner's Guide. And this was the book I had at TAFE. So traditional cost allocation for production overheads, we are only talking about overheads which aren't directly associated with production, because you've got to put a value, a rate on the other departments, your overheads, away from production. It involves firstly getting a figure for total manufacturing overheads. That's step one. Step two, you select a significant input in production that is most meaningful, such as labour hours or machine hours, whatever's the most pertinent. That's your cost driver. Next, you divide the total manufacturing overheads, for example, $200,000 over the total input selected, e.g. 2,000 direct labour hours. So production is, what you got to do is divide the numerator, which is the total manufacturing overhead cost, divided by the direct labour hours, DLH. So production, now you know $2,000 divided by 2,000 labour hours gives you $100 an hour. So production is charged at $100 an hour. So at that rate, $100 an hour, if you know a job in the future is going to take 5 hours, then the manufacturing overhead costs total is $500 for the job. Simply the hours 5 multiplied by the rate, $100. Okay, and O10 states that these are volume-based cost drivers. Now I'm going to just point out the high-low flexible budget formula, and I'll just move to the whiteboard. I'm only casually dressed because it's a beautiful late spring day in Sydney, fantastic beach weather, but you might have it. I'll just focus on what's important, what you really need, because you're given other information, revenue statements and other info. I'll just focus on what we need. So say in a period, a financial year, you had the whole production, like you had diesel fuel, say it's a timber cutting operation, pine forests near Tumut or something. So you've got a machine which is your timber cutter, measured in machine hours, MH. for all months. But you get the highest one, December 4,000, and the lowest one, June 3,000 in machine hours for your timber cutting operation. And you know that you spent diesel fuel for that machine. The highest figure it was in December, $8,000, and the lowest figure was in June, a quieter month, 5,000. So now you've got to go ahead and find the difference between the high point and the low point. So 8,000 minus 5,000 gives you 3,000. 4,000 machine hours minus 3,000 machine hours gives you a difference of 1,000 machine hours. So now you can get an hourly rate in this flexible budget. So you put the difference in the fuel input in the numerator, and you divide it by the difference in the machine hours in your denominator. It gives you $3 variable cost per hour. Okay. Now we can use this rate in the future, and that may change in the future. Sometimes you've got to recalculate the rate every few years. That's in your records, so you know how to charge jobs. In the next period, say we knew a job was 5,000 machine hours, you simply multiply the machine hours in that job card, 5,000, multiplied by the rate, 3,000. We know that that job's going to cost $15,000, and that's variable costs. And say we, actually that's not 5,000. Say we knew total cost was 40,000, right? So now we know variable costs. Then because fixed cost plus variable costs equals total costs, the fixed cost, the missing figure, has to be 25,000. Given that total cost is 40,000, we know variable cost is 15. The missing figure has to be 25,000. Okay, and I'll just flip the whiteboard over for the next topic, which is the step method, which we'll get to fairly soon. I'll just take a seat again. And so that's how you do a high-low flexible budget. Okay, and that formula, total cost plus equals fixed costs which don't change in a production range plus variable costs which do change in a production range. That's a very important formula, and flexible budgets are important because we're comparing the actual figure from the budgeted figure. Any budget, we do that to get unfavourable variance if it's gone over budget, or favourable variance if it's gone under budget. There are exceptions with capacity variance, which we'll get to later, because if you're not operating at full capacity, you're still incurring the same overhead, so you may as well be operating at full capacity, assuming that your consumer demand for the products is holding for the period. Now the step method is on the board. How this works is you're allocating service departments, which other departments not manufacturing. You're allocating a rate to manufacturing. Okay, and I took an example from O10 section 5 page 22, but I changed the figures, the same methodology. So how it works is you've got 5 departments, and manufacturing is your main key department, your core business, but you've got 4 other departments as well. I just said assembly, painting, the painting department, the finishing department, and the packing department. Okay, now you're going to get all this other information, but you're just going to have to focus on what's important, which I did, plus this whiteboard isn't that big. So O10 just said not the same figures as their example, but they said divide up the area space in square meters of all these departments, right? So assembly is 150 metres squared, painting is 300 metres squared, finishing is 175 metres squared, and the packing department is 200 metres squared. Whether these figures are realistic for floor space, it probably doesn't matter. So we as long as you get the methodology. So the total, when you add up all these area spaces, is 825 metres squared. That's our denominator. Now we can set some ratios. So assembly 150 over the total, painting 300 over the total, and so on to get these ratios. And in your question, you might, well, not might, but you're going to have the total manufacturing costs, and I just said 150,000. So now we can find out how these departments contribute to manufacturing by these rates. So the ratio in assembly multiplied by manufacturing total cost gives you that figure. Painting, the ratio, different ratio multiplied by the same manufacturing cost, 150,000, gives you that figure. So you get an idea how these departments contribute. So we can see that painting contributes to manufacturing the most. Next in line is the packing department, and then finishing is the next one along. And I said assembly was the lowest contribution. That may or may not be the case in a real example, but I'm just focusing on the methodology, so you know exactly how to use the step method. It's not that difficult to grasp the step method. I was looking forward to that because I remember doing this at TAFE myself, and I really wanted to go over the step method because you probably will get the step method. So let's just recap different contributions of different departments, indirect departments, getting ratios based on something, in our case area and square metres over the total, and we know the total manufacturing costs, so we simply multiply those ratios of the different departments by the total manufacturing cost to get an idea of the contribution of different departments. Okay. Now I'm going to explain spending variance and capacity variance. Okay. And I wanted to go over this as well, and I'm just going to focus on what's important because there's a lot of info given, as I mentioned. So firstly, we have to get a figure for the factory overhead application rate. Okay. Now the figure for the factory overhead application rate equals, I thought that was a title. That's actually the numerator. So this is our formula for factory overhead application rate. Okay, I'll just put a rectangle around it. So the factory overhead application rate is the first step. You've got to multiply the total budgeted overheads in dollars divided by the budgeted labour hours. That's like a quantity of hours, and that's the cost driver chosen. Okay, so that's step one. Then you got to find the factory overhead applied, which is given by this formula: actual hours, not budgeted hours, actual hours, multiplied by that rate in step one, factory overhead application rate above. And that's sort of like a budgeted figure, okay? And that's actual hours. Now you've got to compare the resulting to actual factory overhead incurred, the actual figure, right? Okay, so compare the resulting to to the actual factory overhead incurred, actual figure. And step 4, now you compare the budgeted results in 2 to actual results to get either a spending variance favourable, under budget, or unfavourable. So I'll just take a look at these notes. So yes, step 2, you multiply the factory overhead applied using this rate, and so that rate is in dollars per hour. You multiply it by actual hours, as we mentioned, right? That's step 2. And then you once you've done that, that gives you a big figure in dollars, and you compare that big figure in dollars, which is factory overhead applied, with actual factory overhead incurred. So the difference between the two, and then you compare the figures, and if one is greater than the other, say the actual factory overhead incurred is greater than the factory overhead applied using this rate, that's actually favourable. So it's a bit confusing because you might think it's unfavourable because overhead incurred is greater, but spending variance and capacity variance is might be a bit different to what you expect. So you know the actual factory overhead incurred, actual result. You've got the budget figure, which is actual hours times your rate in step 1. So if that figure is great, the actual factory overhead incurred is greater than that multiplication, it's actually 20,000. Say it was 20,000 difference. It's actually favourable. Okay, and we also can get a figure for. Oh, actually, sorry. No, you don't say it's favourable or unfavourable just yet. Just sorry, I mentioned that. Now what you've got to do is set flexible budget at actual hours. So you know the fixed factory overhead, and you've got to find the variable now, and that's actual hours multiplied by a different rate. Now, what this rate is, it's your variable rate per direct labour hour, and it's 140,000 in the O10 example is budgeted variable factory overhead. So you know that in the question you divide it by the budgeted hours. And once you've done that, you've got a rate, and you multiply that rate by actual hours to get variable costs. So you add up the two, the fixed and the variable, to get total. And sorry, I was getting confused. That budgeted figure was budgeted for more. That's favourable, so that's okay. It's the capacity variance that's a bit different. Okay. So again, that second rate, not the rate on top, step 1. Another rate you use to get variable costs is your budgeted variable factory overhead, which you know on the question, divided by budgeted hours, which you're also given the question. Multiply that. Divide it. Divide the variable factory overhead divided by the budgeted hours to get a rate. Now, to get total variable, you multiply that rate by actual hours. That's your variable cost. You already know your fixed cost. Add them together. Fixed plus variable gives you total. Compare it to the actual figure. If the budgeted figure is more than the actual, that's favourable. Okay, that's how you do spending variance, all right? And finally, I'm going to go over capacity. Now, I didn't have enough whiteboards, so I just wrote it on this piece of paper, and I'm going to hold it to the camera nice and close so we can see. Has to be really close, and I'll just zoom it in. I'll read out these two. Hang on. Oh yeah, that's a bit better. You got to hold it really close. So O10 section 6 page 17, capacity variance, budgeted fixed factory overhead divided by budgeted direct labour hours, the cost driver, gives you the overhead application rate, okay? And that is equal to dollars per direct labour hour. That's your rate of 1 hour, right? The dollar measurement of direct labour hours, right? You get that by budgeted fixed factory overhead divided by budgeted direct labour hours, okay? That's your overhead application rate, okay? We're focusing on fixed factory costs this time, and remember that numerator figure is fixed, all right? Step 2, you find the difference in the quantity of cost driver, like that's your direct labour hours, right? That's a quantity, not a monetary measurement. If the budgeted hours is greater than actual hours, that's actually unfavourable. I'll tell you why, because it means you haven't reached your capacity, but you're still paying the same overhead. So you want production to be up to capacity. You might think if budgeted labour hours is greater than actual hours, that's actually favourable. It's the other way around, because we're talking about capacity. You want to get to full capacity because you're still incurring all those overheads. And because you could have input more labour hours for more output with the same overheads, you're not really getting enough return on your overheads. So that's actually unfavourable. On the other hand, if budgeted hours is greater than actual hours, that's favourable because your return on overheads is better. You've increased your labour hours to get more output to full capacity. There's another way of doing it in the O10 source. How you do this is first you find the variable rate per direct labour hour, which is the budgeted variable factory overhead in your numerator divided by budgeted direct labour hours in the denominator. Step 2, you find the actual variable overheads by multiplying this rate in step 1 by actual direct labour hours. Actual direct labour hours, not budgeted, which is your cost driver. Step 3, you now add existing fixed factory overhead to variable overheads found in 2. Remember, in step 2, that was a representation of variable costs. Add fixed and variable to get total costs in your flexible budget, okay? Step 4, now you compare this figure in 2 to factory overhead applied. Actual hours multiplied by fixed factory over application rate found at the top of the page, that rate, okay? So you're comparing the figure in 2 and 3 to factory overhead applied, which is actual hours multiplied by fixed factory overhead application rate at the top of the page, that one, right? So now if it's at capacity, if capacity is not full rather, that's unfavourable. Your budget figure is greater than actual, But if your budgeted figure in that methodology is less than the actual, that's actually favourable, all right? So opposite to what you might think, but it's a little bit different. We're talking about capacity. So I'll just I'll put that, I'll stop shaking the camera around, video camera, and I'll just read out that, recap. So with capacity variance, first you find the overhead application rate, which is budgeted fixed factory overhead divided by budgeted direct labour hours, DLH, which is your cost driver. That's $1 per direct labour hour figure. Then you find the difference in quantity of cost driver, direct labour hours. If the budgeted hours is greater than actual hours, it's actually unfavourable because you could have produced more, getting to capacity. But if budgeted hours is less than actual hours, that's favourable because your return on overheads is better. You've increased your labour hours and increased your input. The alternative methodology is first find variable rate per direct labour hour, which is budgeted variable factory overhead divided by budgeted direct labour hours in the denominator. Now you find the actual variable overhead by the rate and the step I just mentioned multiplied by actual direct labour hours. Okay, the cost driver. Now you add the existing fixed factory overhead to variable overhead, which makes sense to get total flexible budget costs, all right? Now you compare this figure to the figure in 2, which is the difference of quantity of cost, and to factory overhead applied, which is actual hours multiplied by fixed factory overhead application rate, which remember was found by budgeted fixed factory overhead divided by budgeted direct labour hours. So you multiply that rate by actual hours, and that gives you a figure in dollars, right? So you compare the two figures, which is you compare the two figures, which is the capacity at both your actual level and your capacity in actual results. Now remember that capacity is found by actual hours multiplied by that rate in step 1, which is budgeted fixed factory overhead divided by budgeted direct labour hours, right? And you're seeing if you're getting a variance, that's actually capacity variance, that calculation, and if that's lower than the actual figure, budget level of activity, then that's actually unfavourable because you could have been operating at more capacity. Alternatively, you can use what's called an ABC rate. You know your fixed costs, you get variable by actual hours multiplied by another rate, which is variable direct labour hours, which is your variable factory overheads given divided by budgeted direct labour hours, right? That rate you multiply by actual hours, and that gives you total variable costs. You add it to fixed costs and find that, and then now you're comparing it with factory overhead applied, which is actual hours multiplied by that other rate we found, which is budgeted fixed factory overhead divided by budgeted direct labour hours, right? And then you compare the two total costs, and if the capacity variance, define the difference. If the if the budgeted figure is greater than the actual figure, that's actually unfavourable, because you could have been operating at more capacity. But if the budgeted figure is less than the factory overhead applied, found by actual hours multiplied by the rate in step 1, then that would mean that that's actually favourable. The budgeted figure is less than the actual figure, alright? Now, I'll just recap over that spending variance stuff again. It's on the whiteboard. I'll just zoom it in. So let's just check our methodology for spending variance. First of all, you get given some information, right? I'll just focus on what's important. Step 1, this is spending variance now. You find the factory overhead application rate, which is the budgeted factory overhead figure, which is given, alright, yep, given in the question, divided by the budgeted labour hours. You get a rate. Step 2, the factory overhead applied amount is actual hours multiplied by that rate in step 1, right? Step 3, you compare actual factory overhead incurred with the figure you've just calculated, which is like your budgeted figure, right? But don't make your conclusions just yet. There's another step. You've got to add the fixed costs in the flexible budget given in the question, right? And add that to variable costs, which are found by actual hours multiplied by the rate, which is variable rate per direct labour hour, given by budgeted variable factory overheads in the numerator, divided by the denominator, which is budgeted labour hours. That gives you a rate. Well, that rate, to get total variable costs, that rate you multiplied by actual labour hours to get total variable costs. You add up the two like you always do. Fixed plus variable gives you total costs. And now you can compare those total costs against actual factory overhead incurred. And that's given in the question. And if the budgeted figure is higher, you've set a budget higher than the actual figure, that's favourable. But if the budgeted figure is if the actual figure is greater than the budgeted figure, you've gone over budget, which is unfavourable. That's what you'd expect in spending variance, but capacity variance is different, because if your budgeted figure is higher than your actual figure, that's actually unfavourable in capacity variance, because you could have been producing more, putting more labour input hours into production, getting the operation up to capacity. So yeah, as I mentioned, capacity variance is a little bit different to what you'd expect with the unfavourable and favourable. Anyway, sorry, I'm Stephen from TEFAT. Sorry for getting a bit flustered about spending variance and capacity variance. It can be a little bit difficult, but if you practice them, you should be okay. My source is OTAN Management Accounting Principles, Learner's Guide, section 6. On that, I did take some other parts, which was just looking at the key concepts of section 5 and 7 as well. Oh, sorry, I haven't finished. If you can stay, there's a bit more. Yeah, there's some more terms. So product costs are costs directly associated with production. Period costs are costs occurred in a period. Now, this is the final topic. It's the difference between direct costing and absorption costing. Now, absorption costing gives you figures that are fixed and variable, which you'd expect, but direct costing only refers to variable costs, direct materials and direct labour, and variable factory overheads. Items directly charged to production, but only variable costs. You can't do that for official financial reporting because it doesn't match the international accounting standards for revenue statements, statement of financial performance. But in direct costing, your gross profit is derived from sales minus variable costs, which is actually your contribution margin. Sales minus variable costs gives you contribution margin. So when you compare absorption costing, revenue statements, and direct costing revenue statements, fixed costs will be included in COGS in absorption costing revenue statement, while in direct costing only variable costs will be included in costs of goods sold, which is opening stock plus purchases, gives you goods available for sale, less closing stock. So only in direct costing, only variable costs are mentioned in COGS on the revenue statement, all right? But direct, as I mentioned, direct costing isn't acceptable for ATO revenue statements. You have to use absorption costing because they've got fixed costs, which is more of an accurate representation of operations. But for internal records, you can reconcile direct costing and absorption costing. That direct costing is useful for internal records because fixed costs generally don't change over production range while variable does. So that's why management accountants like direct costing. It only focuses on variable costs which are pertinent in operations. So again, my source is, let's zoom it in there, Management Accounting Principles Learner's Guide, Open Training and Education Network 010. I went there at Strathfield and I took some concepts from section 5, 6 and 7. Alright, now I really can say the goodbye after all that. So I hope this introduction to management accounting has helped you. Again, I'm Stephen from TEFAT and I've quoted my source, and have a good rest of the day. Bye.